Good afternoon, dear traders. Today and in the coming webinars, we will focus on fundamental analysis. Of course, the lower the trade holding frame, the less the influence of the foundation, but its influence within the framework of intraday trading will be expressed more by reaction than by dynamics. But already in the construction of investment portfolios, long-term or medium-term transactions, the choice of timing for entry, the foundation, plays a very important role. If you are burdened with your main business or work, then it is the style of medium-term transactions that will suit you more, and therefore the foundation should not be discounted. First of all, it is worth highlighting two groups of statistical indicators, leading and lagging. Those who are late due to their strong semantic meaning attract a lot of attention, even too much. For example, in the same publication of GDP figures, but the GDP values are already lagging, and it is possible to estimate in advance the forthcoming GDP figures through the prism of ISM. That is, in fact, when the GDP figures are published, if they do not differ greatly from the forecast, which is very rare, the expectations are already included in price. Let's look at the first picture. So, the first and one of the most important statistical indicators of the ISM Manufacturing Managers Index. So that was not unfounded. I plotted the dynamic of the S&P 500 and ISM, as well as PMI and GDP. You can see that, albeit a little on a larger scale due to the more rare and delayed publications of GDP figures, but a very dense correlations which reached 60 or till 80%. Here, S&P PMI, very close correlation, and PMI GDP. And it seems like the world is in the post-industrial era. But we see that the manufacturing ISM indicator still plays a very important role, since there will be no economy without production. What is ISM Manufacturing PMI? The Institute of Supply Management ISM Manufacturing Purchases Managers Index PMI report on business is based on data complied from monthly reports to questions asked of purchasing and supply executives in over 500 industrial companies. For each of the indicators measured new orders, backlog of orders, new export orders, imports, production, supply deliveries, inventories, customers' inventories, employment, and prices. This report shows the percentage reported each response, the net difference between the number of responses in the positive economic direction and the negative economic direction, and the diffusion index. Responses are raw data and are never changed. The diffusion index includes the percent of positive responses plus 1/2 of those responding the same considered positive. The resulting single index number is then seasonally adjusted to allow for the effects of repetitive intra-year variations resulting primarily from normal differences in weather conditions, various institutional arrangements, and differences attributable to non-movable holidays. All seasonal adjustment factors are supplied by U.S. Department of Commerce and are subject annually to relatively minor changes when conditions warrant them. The PMI is a composite index based on the seasonally adjusted diffusion indexes for 5 of the indicators with varying weights. New orders 30%, production 25%, employment 20%, suppliers deliveries 15%, and inventories 10%. A higher than expected reading should be taken as positive, bullish for the US dollar and S&P 500, while a lower than expected reading should be taken as negative, bearish for the US dollar and S&P 500. At the same time, numbers above 50 seem to indicate that the business cycle is expanding, and below 50 that the business cycle is declining. But if you are just focused on 50, then the indicator can also become lagging. So we need to understand the natural statistical framework where the indicator probabilistically signals the recovery of the business cycle and where the risk of its complete completion is. So let's look second picture. So if you look at the long-term ISM chart, we can see that since 1919, the natural range of the indicator has been in the region from 40-50 to 60. You see, it's a normal range of this indicator. This exactly reflects the very business cycle. There is no 100% cure for all ailments that there are imbalances, as happened in the 18th, you see, such as here or here. With the indicator peaking at 70 or falling to 35. That is why it is important not only to analyze statistical data, the technical picture, but also to be able to work with risks, cut losses in time, and be able to take an acceptable profit. Let's look at next picture. See also how the value now at 60 in ISM begins to be reflected through the volatility index and 20. In the long term, with the S&P 500 growth, the normal value of the VIX was at 10. But with the arrival of the pandemic, the market became more cautious. The demand for hedging increased, and the VIX was already more than a year is kept above 20. Moreover, every time the probability of a reaction is high for 20 now, last year. You see this area that holding more than a year. And here is the reaction according to the S&P 500 index at the high, both to the ISM indicator, although according to this indicator, the reaction can measure for month. And through the prism of weeks, where the reaction is much faster, we see how technically exactly the index reacts to 3,980. You see this price. So here is a road, optimistic buyers are starting to retreat. So from here, aggressive selling comes, then to 3,963, this price. Why this price? It's also important price of selling pressure. So here falls breakout, and your portion of optimists fall into a bull trap again here. Panic selling is in action. And also aggressive selling and does not hold 3,940. You see this price, this very strong level from which movement started, holding here, and there was not even enough strong support to return optimism and strength of buyers to the market. So you see here, technically all clear. And it's very important to be able to read the chart. The second indicator from the ISM series is non-manufacturing indicator. Cycles can also be traced here, which on average end in the region 63 and usually have a cycle from 52 to 63. Let's look. Here, normal ranges of the business cycle from the prism of ISM, non-manufacturing. What are non-manufacturing ISM? The Institute of Supply Management, ISM, Non-Manufacturing Purchases Managers Index, PMI, also known as the ISM Services PMI, report on business. A composite index is calculated as an indicator of the overall economic condition for the non-manufacturing sector. The NMI is a composite index based on the diffusion indexes for 4 of the indicators with equal weights: business activity, seasonally adjusted, new orders, seasonally adjusted, employment, seasonally adjusted, and suppliers' deliveries. A reading above 50% indicates the non-manufacturing sector economy is generally expanding. Below 50% indicates the non-manufacturing sector is generally contracting. The non-manufacturing ISM report on business is based on data compiled from monthly reports to questions asked of more than 370 purchasing and supply executives in over 62 different industries representing 9 divisions from the standard industrial classification SIC categories. Membership of the Business Survey Committee is diversified by SIC category and is based on each industry contribution to gross domestic product, GDP. A higher than expected reading should be taken as positive bullish for the USD and S&P, while a lower than expected reading should be taken as negative bearish for the US dollar and S&P 500. So the logic of the analysis of non-production ISM is similar to the production ISM. It's like an indicator complementing the overall picture. As an example of trading decision yesterday, I made 2 trades, taking into account the analysis of ISM and VIX. Although these trades were intraday in nature, I kept this indicator in my head because I understood the importance and impact of the market. Let's look at the next picture. So the first trade was in the tech index, where purchases began to weaken as they approaches 12,985. So you see here, stop this price, here the point of selling pressure, and here, and it's again stop at this price. And there was no impulse on the breakout attempt. That is, a combination of both correlation, prerequisites, and the nature of the price. Further, the assessment of volatility potential already considered in previous webinars. And the picture is that the risk is more than justified in this situation. So 6-1 in this trade realized. This is 1 minute chart. Next picture. And all these ideas also from VIX index near as a reaction near 20. I showed you. And on the same day, an even stronger trade with a potential of 15-1 on a false breakout of the S&P 500 sell point. You see here, sell point, where pressure began. And here, again, reaction. And no impulse here. So buyers were weak here. Of course, it was possible to subtly take profit twice with the instrument, but the movement where I sold from 395.6 with the addition closed at break-even. The second trade is already on the way of a good trend movement. So first trade was here. Because I see this trend line, I see consolidation and break of this consolidation. Then I try to add in this position here, but break even here. If I can close this deal here, I can realize 5-1. But I expected to see more deeply movement. But next day, theme. Here, it was a good trade because it have enough volatility, it have enough potential, and we see here selling pressure, selling point, and then gradual closing this position and 20% still holding there. And once again, VIX. This is the main idea. So, today we started our fundamental analysis cycle and looked at two very important leading ISM indicators and look at the impact on the market and how trading decision can be made. There is still a lot of information on statistical indicators ahead of you, and each of them plays a very important role. Until next time, and all the best for you.